Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hi friends, let us now move to the revision of our last chapter in the syllabus of financial management, that is our working capital management. Friends, till now we have seen various chapters from the beginning. Most importantly, we said our financing decisions is a very important chapter, then we said capital budgeting is a very important chapter. Likewise, working capital management is also a very important chapter from the examination point of view. Now, why it is important? Because it is not only huge, it also has got a lot of units in it, just like our financing decisions. Okay, before now we move to the main understanding of what is working capital management. Let's first see what is that we are going to study in working capital management. So, working capital management. Friends, in our horizontal format of balance sheet, we know on the left hand side, first we have long-term funds, then our short-term funds. Here we will have long-term assets or fixed assets and short-term assets or current assets. Now, what are the long-term funds we have? We have something like our equity, then preference, then debentures, like this. Now, the study of all these long-term funds, we called it as a chapter financing decisions. We studied it thoroughly? Yes. Or we revised it? Yes. Then, the study of all the long-term assets or the fixed assets, to be even more precise, we call it as capital budgeting decisions or investment decisions. Now, what are left out? Our short-term funds, that is our current assets or current liabilities. Now, the study of this short-term funds and short-term assets or our current assets and current liabilities together is our working capital management or working capital decisions. Now, why do we call it working capital decisions? Instead, why is it called working capital management? Here, more than decision, we are supposed to manage the working capital. Now, what is this working capital management? How do we do that? Is all we will understand in the later part. So, as of now, what is the basic understanding? Working capital management is the study of current assets and current liabilities or the balance or the fund required to address this working capital of current assets with the help of current liabilities is called our working capital management. Now, friends, we all know that is we follow a very specific pattern of understanding our concepts. So, in the same way, what is working capital management? In our style of conceptual understanding, working capital management is nothing but management of working capital. Absolutely. Okay. So, you have to manage the working capital. For that, to understand what is working capital. What is working capital? It is the capital required for working. What is meaning of working? Can we give some other names to understand things better? It is the capital required for not just working, for running the business, or can we say for operations? Absolutely yes. Now, the moment I said the capital required for working or running or operations, now how do we understand what is the capital required for working or running? Friends, we said we have long-term funds and short-term funds, and we have fixed assets and current assets. Conceptually, let us mathematically first of all understand what are the funds required for working of the business. How do we understand it? Now, long-term funds are there, short-term funds are there. What are these funds required for working capital? We said long-term funds will be used for fixed assets. We know that. Absolutely. Long-term funds, long-term assets, or long-term capital, long-term assets. Now, long-term capital for long-term assets. What about short-term capital for short-term assets? Now, tell me, the entire long-term assets or the fixed assets will be funded by the long-term funds? No doubt, yes. Will the entire current assets be funded by the short-term funds? No. Friends, our current assets will and current liabilities. This current assets will speak about our liquidity position. If you remember, what is in our ratio analysis we said, what is the ideal working capital ratio? 2:1. Meaning what? Current assets by current liabilities 2:1. Current assets are expected at least to be twice of current liabilities. Meaning what? Current assets should be more than current liabilities. Yes. Then if we say, sir, current liabilities are used for funding current assets, do you think current assets or the current liabilities will be completely utilized for current assets? No. A part of current assets are funded by current liabilities. I repeat, only a part of the current assets are funded by current liabilities. Therefore, then from where are the rest of current assets funded from? Long-term funds. I repeat, a part of current assets are funded by current liabilities. Therefore, the excess fund or the fund required for the purpose of addressing the current assets. So, can we say, acha, therefore, working capital is nothing but of all the values of current assets, if some is addressed by current liabilities, what is the balance to be addressed? That is our working capital. Therefore, our working capital is current assets minus current liabilities. This is our mathematical understanding of funding of working capital. Now, conceptually, what does this mean? Now, friends, what is the basic objective of financial management? We know it is wealth maximization. Yes. Now, how does the wealth maximization happen? Only when the company can generate some revenues and profits? Absolutely yes. From where will the company generate revenues? Will the company generate revenues from the fixed assets? Fixed assets are used to generate revenues. Okay, for example, I am into some manufacturing of some products. Now, I have some machinery. Am I buying and selling machinery, or with the help of the machinery, with the help of the land, with the help of the building, with the help of fixed assets, am I manufacturing the products and selling? I am manufacturing the products and selling. I am not buying and selling the machinery. I am not buying and selling land. I have some product to manufacture, say some cameras, some mobile phones, or some whatever it is, some product, medicines, whatever it is. End of the day, I am trying to manufacture and then sell. So, the product what I am supposed to manufacture will generate revenue for me. Yes. Okay. Now tell me, these products, the moment I buy the raw materials, will they generate cash for me? No. What happens? The moment I have to start the business, I start my operations means what? I will first purchase the raw material. Okay. Then what happens? Acha, I purchase raw material. Do I get cash? No. Raw material goes for work in progress. Oh, next stage. Fine. The moment it is being sent for working, the work is being done, do I generate cash? No. The work in progress, again, it will be done once the finished goods are ready. Okay, once the goods are ready, am I getting cash? No. They are sent to the warehouse. They may not be sold immediately. Then what happens? Again, later they are sold. Oh, they are sold, I'm getting cash. No. They may be sold on a credit basis. If I'll have debtors. Okay, then what? Finally, I will get cash. Again, I will use that to buy raw material. Therefore, there is a lot of time lag for my cash to become cash. Yes. Therefore, meanwhile, from where do I get the funds to run all these things? In the name of working capital. So, therefore, the funds which are required for the purpose of running the business. Now, friends, once the process starts, once the working capital starts, once cycle starts, then no need of extra funds. Whatever the funds required for the cycle, for that time period, if I am able to generate and arrange, that is sufficient for me. Therefore, what is that fund which is required for running the business? This is not to purchase the fixed assets. This is not to purchase the land or building or machinery or whatever. This is not to make a decision for the project. This is to run the business. What is the amount required? So, this is how conceptually we understand what is working capital required. Therefore, conceptually we understood this, and mathematically we said, what is working capital? Current assets minus current liabilities. Now, friends, we said working capital is current assets minus current liabilities. Alright. Now, what are these current assets? How do we define these current assets? Current assets are those which are sold or intended to be sold for the purpose of trading of the company. Then, which are sold within the operating cycle, and lastly, which are sold within 12 months from the accounting period. These are the three important golden rules. I repeat, what are current assets? Current assets are those which are intended to be sold. What is first and the most important point? For the purpose of trading. For the purpose of trading. Now, friends, Say for example, I have issued shares, I have sold the company shares or issued shares, I got some money. Now, is it current asset? No, it is not for the purpose of trading. Or I am selling some machinery, is it a current asset? No, that's not for the purpose of trading. If making machines is my company's business, then that will become a current asset for me. But purchasing a machinery, purchasing a land or purchasing a building and then selling it off, raising money by selling these properties is not my generating of funds with the help of current assets. They are fixed assets. Therefore, current assets are those which are which generate money, which are intended to be sold for the purpose of trading. Then it has to happen within the operating cycle of the company. Then lastly, within 12 months of the accounting period. So these are the categories which should which should meet for the companies to be called, for the assets to be called as current assets. Current liabilities, exactly opposite to this. What? Which are purchased for the purpose of trading, which are purchased within the operating cycle, which are purchased within 12 months of the accounting period. So these are our current assets and current. This is the definition of current assets, current liabilities. Now, what are the current assets? We know very clearly. We know what are our current assets as per the definition. If you look at which will come under our working capital, the current assets are firstly we will call inventory. So this inventory or stock can be of raw materials, work in progress, or finished goods. Absolutely yes. Now, do we see in the working capital management? Yes, we will see all the three. We will see all these three in our working capital management. Then bills receivable. This is our debtors. Then cash. Cash in bank, cash in hand, marketable security, all these things. And prepaid expenses. Cash or cash and marketable securities. Now, what is most popular in our working capital management? Raw materials, so stock of raw materials, work in progress, finished goods, our debtors and cash will be seeing in our computation of working capital, estimation of working capital required. And just like this, what is our current liabilities? What will be seeing? Majorly, what will be seeing current liabilities? Nothing but bills payable. Here, the majorly we will be seeing are two items. One is our creditors for raw materials, and then outstanding expenses. These are the two items what we will be seeing majorly in our estimation of working capital for the purpose of computation of working capital under the head of current liabilities. So friends, now that we have seen what are current liabilities, let us now move into the computation of working capital. Now, computation of working capital, how do we compute? That is the major task, the motto of this entire chapter. Working capital management is computed based on two ways. Most popularly, it is computed as a percentage of sales is one method, as a percentage of capital employed is one method, but most popularly there are two methods which we will also be following from the examination point of view. Let us understand those two methods now. Methods of computation of working capital. Now, they are computed based on two ways. That is, one is based on time, the other is based on value. Now, the moment we say it is based on time, again it is categorized into two types. Working capital is of two types when it is on the basis of time. That is permanent working capital and temporary working capital. Again, when we say on the basis of value, it is again categorized into two types. What are those two types? That is value. One is gross working capital, the other one is net working capital. These are all the theoretical ways of understanding. First of all, what is working capital? How is it computed based on? So we said on the basis of time. Now, on the basis of time, we said permanent working capital and temporary working capital. Now, what is permanent working capital? Friends, the working capital which is required at all times, which is permanently required, is called our permanent working capital. In other words, it is a minimum amount of working capital required by any company is the permanent working capital. Now, what is the temporary working capital? That is the working capital which is required over and above the permanent working capital. On what basis? On the basis of situations. Say for example, seasonally, the company may require more working capital. Then it is called as temporary working capital. In other words, in simple words, the working capital which is required over and above based on situation is called our temporary working capital. Over and above the permanent working capital is called as temporary working capital. So this is based on time. On the basis of value, we again have two types, that is gross working capital and net working capital. What is gross working capital? The amount of working capital invested completely in the current assets alone is called the gross working capital, and the working capital net of current assets, net of current liabilities from the current assets is called our net working capital. That is only current assets if we consider, it is gross working capital. We also consider the current assets minus of current liabilities, what is the fund required, as what we have seen earlier, that is called our net working capital. So this is based on time and value. Now friends, let us now move to the next step, that is to consider what is the importance of understanding the adequate working capital. Importance of adequate working capital. Now, why are we talking about this importance of adequate working capital? Because the moment we said working capital, we should know first to estimate what is working. That is the, as we said, that is a primary motto. But before jumping into the method of computation of working capital, we are talking about the importance of adequate working capital. Why? Now, if you remember friends, anything in life, whatever we do, the first thing when somebody says something to do, the first thing what we'll ask, what happens if we don't do? That is usual kind of mentality what people have. Yes, okay, in a way it is good also. Now let us understand what happens if we don't maintain adequate working capital. Now there are only two things which can happen. What is that? If the working capital is not adequate, means what? Either the investment in working capital is over investment, or it could be under investment in working capital. Yes or no? Over investment in working capital or under investment in working capital. Okay, now what are the problems of these two? If you understand, it will be better for us to understand the importance of working capital. Absolutely correct. Now, what is the problem with over investment in working capital? The first problem is over investment. High amount funds are blocked. High blockage of funds. Now, more funds are blocked, meaning what? More cost. Higher amount is blocked, higher is the cost. Therefore, higher cost. Now, we said about the problem of having over investment in working capital. Now, what are the problems of under investment in working capital? Friends, low amount of funds are blocked, no doubt. Which will be lower cost if you say, friends, it is lower cost. First, we are talking about the disadvantages. Now, if low amount of funds are blocked, meaning what? The investment working capital is very less. Investment in less, meaning what? Liquidity is less. Liquidity is less, meaning what? Risk is more. Absolutely yes. Therefore, more risky. Therefore, the first case, it is highly liquid. No doubt, but second case is highly risky. Why? So, the good thing here is more liquid, but this is more risky. Now, here we said the cost is higher. No, the cost is higher, meaning what? The profit is lower. Now, on the other side, if the cost is lower, if this cost is higher in the over investment case, what will be here in case of under investment? Cost will be lower. Cost is lower means what? More profitable. Therefore, there are always two sides of a coin. So, when it is over investment in over investment working capital, it is more liquid, no doubt, but less profitable. The other way around, when the investment is less or under investment working capital, what happens? Now, it is more profitable, no doubt, but it is less liquid. Now, why am I talking about these two terms? Because in computing our working capital, we should be very careful, because we should have a trade-off between liquidity versus profitability. That is the reason why we have been talking about this part. So, when we have to find out how much has to be invested, we should be careful about these two elements. Liquidity is very important, no doubt. At the same time, profitability is also very important. Therefore, if you invest more, you will say, more liquid, no doubt. Boss, more liquid, more cost. More liquid, less risky, no doubt. But more cost, less profitable. Now, we come about the underinvestment. Are less costly, more profitable, but boss, less liquid also. Therefore, there has to be a trade-off between this liquidity and profitability. Now, we have understood theoretically that there is an issue with liquidity and profitability in understanding the adequate working capital. But mathematically, how do we compute this liquidity and profitability? Very simple. For the purpose of liquidity, we can take current assets by total assets or current assets by fixed assets. And for profitability, what we will see? EBIT by total assets. Now, ideally, friends, current assets by this will give us the profitability, no doubt. You have seen this also in the ratio analysis. Total assets, or remember, by total assets, nothing but total investment only. Return on investment is what we see here. Absolutely. Now, this talks about liquidity. Sir, this one or this one, which one? Both give the same decision. I repeat, not same values, but both give the same decision with respect to liquidity. Now, because I have written total assets first before, because it will be easy for us to compare because the denominators are same. Now, here our assumption is basically fixed assets and our EBIT is basically constant. What will vary if you check? Current assets may vary. If as current assets are varying, that will give us the liquidity position. Absolutely yes. Now, as current assets are varying, the denominator also will vary. Absolutely. Accordingly, you can see. Now, because this is just a revision, friends, I am not doing everything. You can check out for the detailed version of this liquidity versus profitability in our main videos. But here, as we are revising, we are just understanding the crux of the concept. That is, liquidity, as the current assets increases, the liquidity increases, but the profitability decreases, and vice versa. That is, as current assets decreases, profitability decreases, but liquidity increases. This is what we will be understanding. Therefore, with the help of these two ratios, we will have to find out the trade-off between liquidity and profitability. And accordingly, we are supposed to find out what is the optimal working capital. Now, the moment I said optimal working capital, what comes into our brain? Our ratio analysis. Again, ideal working capital is nothing but our 2:1. No, that is working capital ratio, friends. I repeat, that working capital, that is a working capital ratio. That is 2:1. Now, do you think for every company that is there? No, sir. Working capital depends. See, the ratio is basically a relative number. It is not an absolute number. It also depends upon various factors. Now, what are the various factors? It depends upon the nature of the business. It depends upon the demand and supply. It depends upon the market conditions, the taxes, the policies of the company, manufacturing policies, the suppliers' policies, also the government policies, also the internal factors of the company, like how the company is managing the cash, how the company is managing the stock, how the company is managing debtors. All these policies will come into picture. As I said, the type of the industry, type of the business, these are all the pricing policy. All these things are the various factors which will influence in understanding or in computing the working capital for company based on the, why am I saying nature of the business? Now, friends, for example, I am running a restaurant business. Now, do you think the working capital what I require for restaurant business versus, say, for example, I am doing some business of manufacturing I'm some infrastructure company. I am constructing some flyovers. Now, do you think the working capital required for both are same? Forget about the size of the investment. I am talking about the time of recovery. Definitely no. In restaurant, what happens today morning? I get the raw material. Maximum by tomorrow, day after tomorrow, maximum it will be over. Hardly maximum 1 week. The highest point. But whereas infrastructure companies, it goes for weeks together, months together, at times years together. Therefore, it all depends upon the nature of the business or nature of the industry also. Therefore, these are various factors. Now, why are we talking about all these things? About liquidity and profitability. Now, to address this liquidity and profitability, there are different approaches. That is, before we jump into the exact method of how to compute working capital, be it based on time or be it based on value, we will see. Before that, we will see what are the different approaches in addressing this liquidity and profitability. Let's now look at the three different approaches. Conservative, aggressive, and moderate. Now, what is conservative approach? It is that approach where our investments in current assets is more. Correspondingly, what happens? Cash balance is more. Absolutely yes. Also, the credit policies of the company are liberal. Now, as a result, what happens? What are the good things? What are the bad things? Liquidity is more. Highly liquid. Highly liquid. Therefore, risk is less. Now, more current assets more investment is made in current assets. Therefore, more idle funds. idle funds are more, cost is more, profitability is less. So these are the features of a conservative policy. Correspondingly, what happens in aggressive policy? No, investment in current assets is less. Correspondingly, cash balance is less. Credit policies are strict or stringent. Liquidity is less. Therefore, risk is more. Now, idle funds are less. Exactly opposite. Yes. Therefore, cost is less. Therefore, profitability is more. Now, what is moderate approach? It is exactly between these two. It's a combination of conservative and aggressive approach to ensure moderate results. Now, friends, to understand, to make it understand things even more better, in our long-term funds, earlier we said long-term funds, short-term funds, long-term assets or fixed assets, current assets. In conservative approach, what happens? Long-term funds fund this, short-term funds fund this. Lot of long-term funds, this is very less. The short-term funds will be very less. Whereas, in terms of aggressive approach, what happens? Short-term funds and current assets, these are slightly lesser. To surprise, short-term funds will be more active in funding the fixed assets also. Whereas, in a moderate approach, to the extent possible, long-term funds will fund this one, fixed assets, and short-term funds will fund current assets. A part may come here. This is a moderate approach. This to understand this, we have our example illustration 1 and illustration 2. If you look at them, you will clearly understand what are these three approaches. That is, what is our conservative approach and what are the features, how is it happening, what is that we will notice at the end of the day. From conservative approach to the aggressive approach, as we understand, as current assets are more, the liquidity will be more for conservative approach, whereas the profitability will be least for conservative approach. And as it is moving from conservative, moderate to aggressive, what happens? The liquidity decreases and profitability increases. This is what we'll be seeing in our first and second illustration. So this is about the basic features of the understanding the importance of adequate working capital. Let us now move into the most important aspect, that is computation of or estimation of working capital or working capital required. So friends, let us now move into the most important area in this chapter, that is computation of working capital or computation of estimated working capital. Computation of working capital. Now friends, we said there are two methods to compute. Firstly, we will follow based on time. Now, what is the method which we use to compute the working capital based on time? That is net operating cycle method. Now, what is this net operating cycle? If we know what is operating cycle, we will understand what is net operating cycle. What is operating cycle? The cycle, as per the name what we go, the cycle during for the number of days for which the operations are done. Sir, what operations are done? What cycle are we talking about? If you remember, I was talking about the time taken for cash to get converted from raw material, work in progress, finished goods, then debtors, and then into cash. Absolutely. This entire cycle, that is to start with the cash turning into raw material, then work in progress, then finished goods, then debtors, and finally cycle. Now, this entire cycle is called as an operating cycle. Now, sir, what is net operating cycle? Now, what are the items in this operating cycle? If we understand, then we will understand what is our net operating cycle. Now, the time taken for the raw material to go from the raw material stage to the factory for work in progress is called raw material conversion period or raw material holding period. There are different names given to the raw material consumption period or raw material holding period, anything is fine. Now, from this stage, it became now, it went to work in progress. Now for work in progress, it is there for a while. How much time did it take to get from work in progress to become a finished good? That is called work in progress conversion period. This is raw material holding period or raw material consumption period. How much time does it take to get consumed? Next, work in progress conversion period. Now, work in progress conversion period is over. It became a finished good. Is it sold immediately? No, no, no. It is held in factory, warehouse for a while. For how many days? That is called finished goods holding period. Then, after finished goods holding period, acha, it is sold. You got cash immediately. No, no, no. We are selling for credit. Therefore, what do we get now? Debtors. Therefore, debt collection period. All this put together is called our operating cycle. Now, just like how we give on debt, even we purchase raw materials for credit. Therefore, just like our debt collection period, we said we also have something called as credit payment period. Therefore, operating cycle minus credit payment period, or all this minus credit payment period will give us our net operating cycle. Now, sir, how do I understand this? If you remember, friends, even at the time of when we understood the concept, also we gave a small example like this. What is that? Say, for example, from here I am going to a new place to work on work. I have to join a new company. Now, till now I have been a student. I have never tried wearing formals. Now, for every month, if I have to compute how many formals should I purchase, now how will I decide that? Very simple. Say, for example, let us assume I have to work for 30 days a month. Okay. Now, do you think I will buy 30 formals? Sir, no, not required. See what we will do. Every week we will do, say for example, weekly once Dhobi comes. Once in 5 days he comes. So every Friday he comes. 5 days he comes. 2 days he will take to wash them, get them ironed and give back to you. Now what happened? 5 days plus 2 days, 7 days. Again on the 8th day you have all the clothes ready with you. Great. So 5, if I have 5 set of or 5 pairs of formals, is it not sufficient? I can wear for all the 4 months or all the 4 weeks? Absolutely yes. Okay sir, instead of once in 5 days, he comes once in 7 days. Okay, no problem. I will invest on 2 more. Now, say for example, 1 pair costs 1000 rupees for me. For 1 month, do you think I have to spend 30,000? I might have to spend 30,000 when? If Dhobi comes only once in 30 days. If I say Dhobi comes once in 5 days, I will spend 5,000, 5 formals. Okay sir, some safety buffer, I want some safety margin. Okay, 2 more pairs extra. So, if I spend 7,000, 5,000 for 5 pairs, safety 2 more. Over, job is over. Okay sir, no, not 5 days, he comes once in 8 days. Okay, 8 plus 2, 10. 10,000, enough. Now, once in 10 days, I can manage these all these 10 pairs. Like this, depending upon the cycle, I will have to invest. Now, one point conceptually what we have to understand here. Sir, if my time is too long, if my cycle is longer, my number of days operating what is this called? The operating cycle is longer. If my operating cycle number of days is longer, the amount I require will be higher. If the number of operating days is lesser, net operating cycle days is lesser, they would be lesser. How? Just like how we said, if I want the entire 30 formals to be purchased, I'll have to spend 30,000 rupees. No, no, sir, instead 10 days is enough, 10,000 rupees. No, no, sir, 7 days is enough, 7,000 rupees is fine. Friends, now here what is happening? 7,000 rupees I'm purchasing and again reinvesting. Yes or no? Therefore, what is happening end of the day, the amount of investment what I'm supposed to make is reducing. Not just that, to get this amount, I'll have to borrow some money somewhere. Therefore, the cost of borrowing also is connected to this. In similar lines, higher is the number of days, higher will be the investment required, higher will be the cost correspondingly. Now, from this net operating cycle, we can also compute the number of cycles. How will you compute? Say for example, this is 20 days, raw material holding period says 20 days. Say this is 30 days, say this is 15 days, say again 15 days again, and say this is 20 days. Now what happened? 50 plus 30, 80 minus 20, this is 60 days. Net operating cycle is 60 days. Now what does net operating cycle 60 days mean? See, 60 days, it is the total cycle time. Means for example, let us say total operating expenses per annum is rupees 24 lakhs. What is my net operating cycle? Is 60 days. Sir, what does it mean? Implies say for 360 days, it is 24 lakhs. Therefore, for 60 days, how much? That is equal to 60 by 360 into 24. 6 cancel. That is 4 lakhs. This is my working capital required or computation of estimated working capital. Now friends, can I also write like this as, so for 360, instead of writing 360 days, 24 lakhs, 60 days how much? Can I say if my net operating cycle is 60 days, then what are the 60 days is called as what? One cycle. So if 60 days is one cycle, how many cycles are there per annum? Can I say therefore number of cycles is equal to 360 by 60, 6 cycles? Absolutely. Oh, so in 1 year 6 cycles. Then for one cycle how much? Very simple. So for 6 cycles it is 24 lakhs. Implies for one cycle how much? 24 by 6. Again same rupees 4 lakhs. This is also another way of computing. So what did we do here? Instead of net operating cycle, instead of days, we said, boss, how many cycles are there? So per cycle will give us the computation of the value of the working capital required. So this is how we compute the working capital required based on the net operating cycle method. So friends, now that we know how to compute the net operating cycle with the help of all these raw material consumption period, all these items, let us now individually understand how to compute these specific items, that is raw material consumption period, work in progress conversion period, finished goods holding period, debt collection period and credit payment period. Let us see. Computation of raw material consumption period. Now, friends, we have what is the raw material consumed per annum? What is the value of raw material consumed per annum? Yes. Now, how much time did it take for this raw material to be consumed? Say some 10 lakhs worth of raw material or 20 lakhs worth of raw material, whatever it is. It has taken around 360 days. Absolutely yes. So, for the purpose of easy computation in working capital management, we will take 360 days per annum instead of 365 days. No great logic in that. Just for easy computation, that's all. Now, if raw material consumed per annum, so if so much of, say 10 lakhs worth of raw material is consumed in 360 days, we have some average stock of raw materials. How do we get this average stock? We have some opening stock of raw materials. We also have some closing stock of raw materials. So, opening plus closing by 2 will give us the average stock. Oh, there is some average stock of raw materials throughout the year. Okay. So, if the raw material total consumed this much per annum in 360 days, for average stock of raw materials, how many days is it taking? That is our raw material consumption period. That is equal to average stock of raw materials divided by raw material consumed per annum into 360. Cross multiplication. Absolutely yes. That's all. Now this will give us our raw material consumption period. Now similarly, work in progress conversion period. Now, for the purpose of work in progress, what do we take? We take the cost of production, because work in progress, once it is converted, it becomes the cost of production. Yes, it becomes produced. Therefore, the cost of production, produce a good per annum, the cost of production per annum is for 360 days. Then, what time will it take for this average stock of work in progress? Sir, how do we get the average stock of work in progress? Same, opening stock of work in progress plus closing stock of work in progress by 2. For this average work in progress, how many days? That is equal to average stock of work in progress divided by cost of production per annum into 360 days. Absolutely. Then what is our finished goods holding period? For this finished goods, what we will take? Not cost of production plus opening stock of finished goods minus closing stock of finished goods, that is cost of goods sold per annum. This is for 360 days. Then for average stock of finished goods, we are taking opening and closing here. For average stock of finished goods, how many days? How many days will it be held? That is average stock of finished goods divided by cost of goods sold per annum into 360 days. Absolutely. Then debt collection period. Debt collection period. Now, debt collection period is based on what? Credit sales per annum. That is 360 days. Then, for average debtors, what will be the duration? That is equal to average debtors divided by credit sales into 360. Now, can we also write this as 360 divided by credit sales divided by average debtors? Why do I write like this? Because this term, if you remember in our ratio analysis, what is this? Debtor turnover ratio. Therefore, 360 by debtor turnover ratio will give us what? Our debt collection period. Now, like this, we will have all the values. For raw material consumption period, some value we will have. Then for this, work in progress conversion period. Then finished goods holding period. Then debt collection period. Lastly, credit payment period. The same lines can we write? Average creditors by credit purchases of raw materials into 360, or 360 by creditor turnover ratio will give us credit payment period. This, therefore, net operating cycle is equal to this. So, this is how we find out the net operating cycle. From this, what we will do? Therefore, number of cycles is equal to 360 divided by net operating cycle. Therefore, and we will have total operating cost or operating expenses per annum is equal to so and so. Therefore, estimated working capital is equal to total operating cost divided by number of cycles. So, this is how we compute the estimated working capital based on time, that is with the help of net operating cycle method. Now, friends, we understood as to how to compute this estimated working capital, but one small point what I want to mention, though you know, because that is as a matter of revision also, I am just mentioning again. How did we get this raw material consumed, then cost of production, all this? We know, we have learned it already based very strongly in costing also, but let's just write down a small note as to how to compute all these three items. That is, note, raw material consumed is equal to opening stock of raw materials plus raw material purchased minus closing stock of raw materials. We know this. Similarly, what is cost of production? That is prime cost. That is raw material consumed plus labor plus overhead plus opening stock of work in progress minus closing stock of work in progress. Similarly, what is cost of goods sold? Cost of production plus opening stock of finished goods minus closing stock of finished goods. Friends, the data of all these items is opening stock, closing stock, this opening stock, closing stock, this opening stock, closing stock, all this will be given to us in the examination. The only thing is, with the help of this, we will find out the averages and also like this, and also finally we will arrive at computing our estimated working capital. We also said, instead of number of cycles, what we can do from the NOC itself, we can say the another method of computing, that is the net operating cycle. For 360 days, the annual operating cost, for 360 days, we have the annual operating cost or total operating cost. Therefore, for net operating cycle days, how much will be the cost, or how much has to be invested, or how much has to be blocked, or what is the fund required? That is our estimated working capital. So this is how we finally compute our estimated working capital based on net operating cycle method. But friends, let us understand one very, very important point. Here we are doing only revision. In revision, what do? We only understand the method of computing. But practically only when we jump in, we will understand as to what are the intricacies, what are the main issues. See, in revision, we cannot, detail to every point, which can happen only when we have the numbers. That is the reason why I said in revision, even for all the other chapters also, what we have revised the concepts alone. And especially in working capital management, this concept, that is computation of working capital based on time, is definitely important for examination. And the most important concept from examination point of view in working capital management is computation of working capital based on value, which is what we'll be seeing now. Let's write down. Computation of working capital based on value. Now friends, there is no rocket science here. It is a very straightforward way of computation. What is that? Working capital is equal to current assets minus current liabilities. Our estimated working capital based on value is also equal to same, current assets minus current liabilities. But one thing we are supposed to be careful here in understanding conceptually, what is this current assets? It is not simply current assets. We will call it as investment in current assets. I repeat, investment in current assets and payables for current liabilities. Now, what is this investment in current assets? How much is that? How much is blocked or how much is invested for the purpose of current assets is what we will be understanding from this. How much will be funded by the current liabilities is what we will be seeing, or how much has been reduced by the current liabilities, so that the balance has to be funded, or the balance has to be the fund arranged in the name of working capital. Absolutely yes. Now, how do we compute this investment in current assets for the purpose of this? Just like how we computed for each element in our computation based on time, that is raw material consumption period, working progress, conversion period, finished goods holding period, like this. In investment, even in value based computation also, we will write down the computation for each current asset separately. Now, what are the current assets we have here? We mentioned earlier already, even in the revision also, we have inventory or stock of raw materials, stock of work in progress, stock of finished goods, debtors and cash. If at all there will be some prepaid expenses. That is what we have the current assets. Now, how do we compute the investment in raw materials, the investment in work in progress, the investment in finished goods, the investment in debtors? How do we compute? The cash balance will be given to us. So and so cash balance is expected to maintain volume. Now, therefore, how do we compute this? Let us see. Let's write down first. Investments in current assets. The first item we said is investment in raw materials. Now friends, for the purpose of computation of investment in raw materials, what is that we are supposed to know? Whatever we did for raw material holding period, exactly opposite is what we will do. In other words, whatever is the last step in the time based method will be the first step in our value based. What is that last step? Just go back and see. So, for 360 days, what is the annual operating cost? For 360 days, if so and so is the annual operating cost, for net operating net operating cycle days, how much? Same style. What is that we are saying? Sir, for the purpose of computation of investment in raw material, we should know what is raw material consumed. Absolutely yes. For 360 days, if so and so is the raw material consumed per annum. If so and so raw material consumed per annum. Now, raw material, we will have some raw material holding period or raw material consumption period. Say that is some 2 months. Then, for 2 months of raw material consumption period, how much amount has to be invested or how much amount is blocked? Is it not the same style? Absolutely yes. Here we are taking the operating cost and the number of net operating cycle, but here we will take raw material consumed, there also per annum, here also per annum, and here we will take the raw material, the consumption period. That's all. So this will give us the investment in raw materials. Similarly, the next step, that is work in progress. Now say work in progress conversion period is 1 month, but 1 minute, careful friends. There is a special point to be followed here. What is that? This is a very, very important point from the concept point of view also. Now, raw material we will take based on the raw material consumed. Work in progress, how do we take? Now, work in progress again 3 parts. What are 3 parts? Sir, we have raw material, we have labor, also we will have something called as overheads. So, raw materials again same style. What is that? For 360 days of raw materials, 360 days, sorry, what is raw material consumed? What is the cost of raw material consumed for 360 days? Then for 1 month of work in progress conversion period, how much will have to be blocked? Absolutely yes, 100% yes. But for the purpose of labor and overheads, we will not take like this. Meaning, sir, for 360 days, what is the cost of labor? Then for 1 month of work in progress conversion period, how much? No. Why, sir? If I take this entire cost of labor, similarly for overhead also what? If I take for 360 days, cost of overheads, then for 1 month of work in progress conversion period, how much? Now, all these values I will have to write here, and finally I will arrive at the final value and write here. Here friends, if I take labor and overheads, now overheads are basically, they are allocated overheads. On what basis are they allocated? They are allocated on the basis of labor only. So unless otherwise mentioned, whatever treatment we give for labor is the same thing we will give for overheads also. If you observe in the questions what we have done earlier, because it is revision, I am not going too deep into things, but just have a glance. If you remember, the language what always the question says is labor and overheads are accrued evenly throughout the year. Now what does accrued evenly mean? Friends, if I simply write cost of, just like cost of raw material consumed per annum like this, here also if I write cost of labor per annum, cost of overhead per annum, what does it mean? That means work in progress is completely over. If work in progress, if you are taking complete labor and correspondingly complete overhead along with complete raw material, what does it mean? At what stage are we in? We are at the cost of production. No. This is work in progress, friends. Therefore, here it is work in progress means it is not 100% complete. Some percentage of completion is there. Now, what is the percentage? That the question will tell us. If the question does not tell us what is the completion, then what should we do? Should I take 0% complete or 100% complete or 50% complete being the average? 50% complete. That is why we said evenly accrued means what? We assume when there is no data given, they are 50% complete. That is the reason why for labor and overheads, we will multiply by 50%. I hope we are clear, friends. These 3 values we will write here. Correspondingly, we will write here, and then we will get the value of just like what is our investment in raw materials, we will compute investment in work in progress. So friends, let us be clear here. Why are we not taking the cost of production? I repeat, friends, why are we not taking cost of production? If we take the cost of production, that means it is not work in progress anymore, it is complete. That is the reason we are not taking the complete cost of production. We are taking only part of labor, correspondingly so much as labor overheads also. As we said, if the question is silent, 50% labor, 50% overheads. Now, at times the question may say labor and overheads are 70% complete. Okay, take 70%, who is stopping you? At some times question may say 80%, take 80%, 90%, say 90%. Question may say, usually it will not say 60% labor, 70% overhead. No, it will not say. Usually it doesn't say. But if it says, take like that. In general, 50%, 50%. This is how we take or compute the investment in work in progress. Next, finished goods. Say this is also some 2 months. Now, for 360 days, for finished goods, what do we take, friends? Cost of goods sold. Cost of goods sold. Then for 2 months of finished goods holding period, how much? that value we will take here. Oh, the stick doesn't come here. Here. Similarly, debtors, again say some 3 months for 360 days. Careful. For 360 days, debtors, so what should we take here? Credit sales or total cost. Sir, where do we get total cost? Everything we are computing on the basis of cost only. Friends, remember, unless otherwise the question tells you, the computations will be done on cost basis. If the total cost data is not given, then you can go with credit sales. But otherwise, conceptually speaking, always prefer this. If the question says specifically compute the investment in debtors based on credit sales, then go with this. Friends, remember, we are computing what? Based on the costs. Therefore, this. Now, here also the question may say for example, only 75% are credit sales. No problem. Of the total cost, you take 75%. Unless the question says consider debtors based on credit sales only then take on credit sales. Whether it's credit sales, 70% credit sales, or whatever it is. But if the question gives the data of credit sales and it will anyways give the total cost data, if say some 70% or 80% or whatever, 80% of the total cost, because always we are computing the amounts to be blocked, friends, based on the cost, depreciation and profit. These things will be ignored. We will always follow the total cost approach. Absolutely, yes. Therefore, for 3 months of debt collection period, how much? Write down. Then we will also have something called our cash. If at all there is any prepaid expenses, will be given to us. The total we will call as therefore total current assets. Absolutely, yes. Done. Similarly, next step will be payables for current liabilities. Now, friends, if you remember, we said usually there are two types of payables for current liabilities. One, creditors for raw materials. Now, just like what we did here, raw material, what is that we have? For 360 days, raw material consumed. Here, what we will do? For 360 days, raw materials purchased or credit purchases. Then say this is again some 1.5 months. Then for 1.5 months of credit payment period, how much? Write down. Similarly, there may be some outstanding payments, so lag in payment of wages and overheads. I am combining both. If it is separate, do it separately, no worries. Otherwise, you can take it together. For 360 days, wages plus overheads cost per annum. Then therefore, for say this is again some 2 months is the lag. For 2 months lag, how much? Friends, here no 50% business. We are not computing the investment. We are talking about the payable. Therefore, full value you can take. That's all. Now you will get the payables for current liabilities. Therefore, working capital is equal to current assets minus current liabilities. So, whatever is our current assets figure here, let us call it A, and current liabilities, let us call it B, equal to some A minus B. You will get the answer. Say the question gives you, says boss, you have some 10% margin plus 10% safety margin. Okay, let us have it. What is there? Therefore, estimated working capital is what we will have plus 10% of safety margin. This is how conceptually we will compute the working capital required for a company based on the given data. Friends, as I told you, see, this is we are revising things here. Therefore, the intricacies, the minute small things to understand, we will know it only when we solve the problems, only when we have the numbers. Therefore, this revision will help us to recap the concepts, but to have a perfection, it is always advisable, just like the other chapters also, we have revised here the method of computation of working capital, estimated working capital rather, and based on this, we can now understand as to how to compute, and let us take the help of, please take the help of the numbers or the problems what we have solved earlier to understand the minute details of all the intricacies and to have a better knowledge over this concept. Now friends, with respect to a new company, there will be a small change in two places in the entire computation. What are the two places where we have the change, and why are these two changes happening? Let us again quickly recap. Now, in case if the question says, boss, the company is a new company, then what happens? Now, where do we find the change? Very simple. Change number one. Carefully listen, friends. Now, we come to the investments place. Now, in investments for 360 days, we said raw material consumed per annum. Now, if the company is a new company, now friends, this raw material consumed here per annum is what is going to production? Absolutely yes. If it is a new company, the raw material, whatever is there in work in progress here, this here, let us call it as some say X. This value of raw material, what is the closing stock of work in progress, whatever raw material in work in progress, the closing stock of work in progress in which raw material is there, that is coming from where? That is also consumed in the same year only. Therefore, here we will say this raw material consumed is actually of two parts. One is production and two is work in progress. Now, whatever we wrote here in the existing one is raw material consumed in production. Now, here therefore, what we will write raw material consumed in production plus work in progress, that is production value is this plus work in progress some X, what we thought that X value you have to add here. Now, this complete thing, say for example, easy understanding, if I say for example, raw material consumed is for production is 1 lakh, this work in progress value says 20,000. Then 1 lakh plus 20,000. Only if it is a new company, friends, we will add this 20,000 to what? To the raw material consumed per annum, which includes production 1 lakh plus 20,000. Where does 20,000 come from? It comes from here. The closing stock of raw material in work in progress will have to be added to the raw material consumed per annum along with the production to arrive at raw material consumed per annum. Now, what happens? Say this is 1 lakh 20,000, this becomes 1 lakh 20,000. So, for 12 months, it is 1 lakh 20,000. Therefore, for 2 months, how much it is? 2 months by 12 months into 1 lakh 20,000. That is by 6. Therefore, this will be 20,000. Now, friends, remember, I repeat, had this not been a new company, this 20,000 wouldn't have been there. Then it would have been only 1 lakh. Then the computation would have been 2 months by 12 months into 1 lakh. So, it is 1 lakh by 6 would have been some 16,697 would have been the investment in raw material in that case. In this case, where it is a new company, this is what we will take. This is place number 1. Second place. In creditors for raw materials, here raw material purchased, we wrote it as same as raw material consumed, because opening stock, we know opening stock plus purchases minus closing stock is equal to raw material consumed. In general cases, our assumption is both opening stock and closing stock are same. That is why the raw material purchased, whatever we will write same as raw material consumed in every problem when it is not a new company. But when it is a new company, will there be an opening stock? No. Then what will be raw material purchased? Raw material consumed plus. So, this will not be here. So, therefore, raw material purchased will be raw material consumed plus closing stock of raw material. Now, friends, therefore, here what we will write? Whatever is raw material consumed, this value, this raw material purchased per annum is what I am talking about. Raw material purchased is raw material consumed plus closing stock of raw material. In the example what you have taken, what is raw material consumed? Raw material consumed is 1,20,000. I repeat, raw material consumed is 1,20,000 plus what is the closing stock of raw material? This one. So 1,20,000 plus 20. So 1,40,000. Ideally, this 1,20,000 raw material consumed plus 20,000. Now this 20,000 is closing stock of raw materials? Yes. Now 1,40,000. So this will be what? 1.5 by 12 months into 1,40,000. Now had this not been a new company, this 20,000 wouldn't have been there. This 1,20,000 wouldn't have been there. This purchases or raw material purchase would have been whatever raw material consumed. In this case, it would have been simply 1 lakh only. The same, this 1 lakh only, whatever was there earlier. Yes, whatever was there, the production. Therefore, friends, so this is number 1, change number 1, and this is the change number 2. So therefore, these are the 2 changes which we are supposed to make when the company is a new company. So this is about the computation of working capital or estimated working capital based on value. As we said, friends, let us go through all the problems, and this is the most popular model in the examination. Let us go through all the problems to understand things better.